Well, Justin, we're back for another episode here and got another bottle of wine. So for those of you that are listening just for the wine pick, we'll get that out of the way. But end of the summer here, so we're gonna go with a little rosé.
There we go, love it.
But yeah, rosé from France. So we got it from Sancerre, La Porte Rosé de Pinot Noir. So we'll enjoy this, and we'll put a link to it in the show notes. But cheers, buddy.
Cheers.
It's your birthday too.
Oh,
so
yeah.
Happy birthday.
Thank you.
We'll let him take the bottle home for the rest of the day.
And no one has to know what time it is.
Right.
Actually.
Well, one thing about this wine I did notice is I think it was a couple bucks more expensive when I went to the wine store. So maybe that's inflation kicking in.
There you go.
What do you think?
It's a hot topic.
It is a hot topic. And that's where I'd love to just start kind of getting your feel. What the heck's going on? I was listening earlier, and one of the big things about inflation is it's actually taking over the top spot on the election cycle, which, we got a very controversial, and we're not going to get into politics, but, abortion's a big issue for this upcoming kind of midterm elections. Mm-hmm. But I mean, inflation is just taking the cake here. So, what's happening? Obviously it's impacting the market. I mean, shoot, I thought we should have maybe just brought whiskey to this conversation, given the ups and downs of the market. It's been at times painful, but then the market's roaring this morning. So the rosé makes sense.
There we go. Yeah. A little celebration. Let's see how long it lasts.
Yeah. Right.
I mean, the short of it is inflation's dominating the news cycle, and has really dominated the news cycle for the better part of this year. It's definitely going to be a big component. I shouldn't say definitely. I can never say anything with great certainty, but it's going to likely be continue to be a big factor or topic within the upcoming election. It's interesting too. It's not unique to the United States by any stretch of the imagination. Actually, the United States has slightly lower inflation than the rest of the world. So it's not unique to us and our economy. That being said, it still is an important topics generally bleed into the political spectrum more often than not. It's hard to pinpoint exactly why inflation happens. I mean, you could, and you probably will hear if you do some general searching, hey, we pumped a ton of liquidity into the system throughout the pandemic and solved a lot of potential problems. I think it's very fair to say that, and you're not going to get too much pushback around that. Solved a lot of potential problems that the pandemic closures, work from home, whatever it was that came about with the pandemic to try and quell the pandemic. We tried to plug that hole with a ton of liquidity, both the government writing checks, the Federal Reserve trying to stimulate, keeping interest rate low, etc. That amount of liquidity, just think an amount of dollars in the system. You have an increased number of dollars chasing a relatively finite amount of goods. That's one part of it. And then you have all the complexities around supply chains. Think about China. They're still going through this today, where if they sniff some sort of COVID outbreak, they're still locking down cities, which significantly impacts manufacturing, which just has this whole bottleneck, or domino effect is a better way to think about domino effect through the supply chain. Sure. Our supply chains were, and still largely are, so what was called just-in-time focused. And so one little hiccup in that entire chain creates a ripple effect for many, many years, many, many periods, however you want to think about that to come. And those two big factors, plus now we have the Ukraine war, or war in Ukraine, these all come together. And it's not surprising that we're seeing inflation. I think there's potentially an argument. I mean, this is where I'm going to get out and somewhat predict the future. Making an actual decision based on this prediction is a whole nother conversation, which we don't do. But you could see a likelihood that inflation comes down somewhat quickly. I don't know if that's going to be next month or the following month or what. But if you just think about it logically, all of that additional money supply, dry powder, has largely been eaten up or spent into the economic system, the economy. The cost to ship a good from China to the West Coast is essentially back down to where it was in the early days of the pandemic, pre-pandemic levels. And so all of these things, obviously the war in Ukraine is still ongoing, and that's a big wild card at how long that goes. That's driving oil prices up. So there are some countering forces here, but you could see the kind of traditional factors that go into this inflation equation somewhat ease in the near term. Again, predicting the future is a fool's errand, but logically it's fun to take a step back and interesting to take a step back and think through it.
Totally. And I think you and I were talking about this at one point in the last few weeks, but we had heard somebody talk about, really this is just a kind of the normalcy coming back to roost to an extent. Like we went through this period of unnormalcy for so long, right? So much money in the system, so much stimulus going on, some different things. And that is the role, right? It's the role of the Fed. It's the role of the government to come in and buffer some of these situations in very complex ways. That's way too simplified. But, we avoided a lot of pain for a whole long period of time. And we kept things artificially low, probably on the interest rate side. And it fueled growth. And now we're starting to have a reversal of some of these things. Like you said, it's not surprising that these things are starting to happen. I think the tricky part, obviously, if you were trying to play this as an active trader, is like, when the heck's is happening? And we know people that we talked to 10 years ago that predicted inflation running away and all this stuff happening. And that was 10 years ago. So to actually figure out when to implement and when to go, I think, I heard another stat this morning just on how timing and how the market prices these things in. It's tough to get ahead of them. Is seemingly like there's this sentiment, and I think we all agree, hey, inflation may come down, but there's probably some short-term pain coming. But when you start to look at it, that's what the market's expecting. So unless we have a divergent, it's one way or the other, you don't really have an advantage. We see that even in mutual fund right now, the cash position within mutual funds typically around 1%. I think those have ballooned to 2.5%. So these strategic, quote unquote, active traders have made the decision to take some risk off. Now they have the really tough trouble or tough task of trying to figure out when to turn it back on. And I think that just goes back to missing the days. There was a stat that ran across my Instagram feed the other day, but it was talking about if you invested $1 in the S&P 500 at the end of 1991, December 31st, and you held that dollar in the S&P all the way till the end of 2021, so December 31st, 2021, that dollar would be worth $20.82. So like a 2,000% increase over that period of time. So 30 years, a long time, right? Yeah. Holding something for you saw a lot during that 30 year period of time. You saw the tech crash, you saw, 9/11, you saw 2008 crisis, you saw a lot of things. But the stark and amazing thing is just 50 days. Think about that. 50 days in 30 years. Yeah. If you miss the 50 best days, your dollar would be worth $1.62. So trying to time the stuff, shoot, man. God bless you if you can figure it out, but we haven't seen anybody could do it.
Totally. And it's easy to look at that data, and we love looking at that data, and we'll always go back to that and say, what does the data say? Just this week, kind of along those lines, there's an article in Bloomberg I have up now around hedge funds underperforming, right? These are supposedly the wizards of timing and predicting the future, quote unquote. And they're underperforming. Flows are coming out of it. So that's the data we go back to, but there's also the behavioral side of it. And we always have to acknowledge, hey, if you look at a long-term chart, you look at what the numbers that you're throwing out, it seems easy over long periods of time. And we don't want to have that conclusion. Periods like today or this year, 2020 at large, they're hard to go through. They're full stop. Yeah. They are. But acknowledging that, knowing that there's a psychological reaction, everyone has it, it's totally normal, but trying to take a step back from that acknowledgement or after that acknowledgement and say, okay, well, what does this mean for the future? Do I have the right structure in place, right? That's always where we're going to go back to. Yeah. And it's been proven that that's, it's largely what you're saying in those numbers, that's where it proves staying power and discipline and all that stuff really, really matters over the long term. But again, I really want to make sure we hit it home that, hey, there's an acknowledgement that periods like this are hard to go through. They're hard to go through for us too. Yeah. But we have the training, the comfort, the experience to say, well, hey, this is actually normal. It absolutely sucks to go through it. I want it to be over tomorrow. And sometimes I'll optimistically try and, whatever, put some energy out there to make it happen. But we know that's not going to necessarily move the needle one way or the other. But just knowing that there's a process in place gives us that confidence to have these conversations and really look forward to the future and know that staying the course, having the right structure in place is the high likelihood, high probability way of going about investing and managing finances.
Yeah, totally. I mean, I was talking with somebody from one of the funds that we actually use, the managers we use, and they were actually talking about, hopefully if, people aren't paying attention as much as normal to the markets, because then, you're saving yourself some of this grief. But for those people that are watching the markets and watching the roller coaster, I mean, it's gut wrenching and it's confusing, right? And I think, there was an anecdote talking to this representative from one of the managers. They have some data that's showing just kind of what's happened with the bond market and the stock market. This is actually very close to the same amount of pain that was felt in 2008. And it doesn't feel that bad sitting here today. I think wow, 2008 seemed pretty bad. But the market's acting in a way and having that kind of impact right now. But I think kind of to your point, it's where we get comfort is there probably a lot of people on their own aren't going and looking up and reminding themselves that a 30-year period when you stay disciplined is going to reward yourself. So it is a good reminder when you're going through periods of time like this to do what we do. It's why we look up these stats, because we need to remind ourselves, hey, don't get emotional here. This is a well-functioning market. It's doing exactly what it should be doing. Lots of uncertainty, high inflation, things are changing, markets reacting. All those things are really normal. And then we just have to go back and continue to remind ourselves about the data and what the best investment experience is going to be for our clients. And that's going to be aligning their priorities with when they need the money so we can appropriately allocate it, right? Because if you're taking your money that you need next year and you're allocating it to this crazy market right now, you should be a ping pong ball right now.
You put it in your Robinhood account a year ago.
Cow, yeah, right. Ouch. Yeah, it's probably a mess. And in that case, don't close your eyes. Look in there and find some help. But I think that's just the good reminder. This is a tough time right now.
Yeah,
I think, and the more we can remind ourselves that it is about a long term if you have the right financial structure.
It is. And, I think I hit on this a little bit last week, but also acknowledging that the market is not the economy. And that acknowledgement or that understanding can kind of go both ways. Right now, the market not being the economy, actually the market's kind of underperforming the economy overall. The economy is doing okay, aside from inflation. The jobs numbers are still growing, slowing down a little bit, but still very, very strong, which is why the Fed has confidence and comfort in continuing to increase interest rates. Yeah. Earnings season, this is where it kind of starts to bleed into the market or the stocks and companies specifically, right? They're different, but they're related for sure. So don't confuse the two. But earnings season's coming around the corner, and I mean it's here. 20 companies have reported. 12 of those companies have actually beat estimates, meaning they've outperformed expectations. The market takes those expectations into account when it's pricing where it is. So more than half have outperformed. That's around probably what you would expect, so to speak, in a normal market environment. So earnings so far, this is a big caveat, we're early in it, so far have not fallen off a cliff or anything like that. And in fact, the broad expectation is for a little bit of growth quarter over quarter. And so just think about that, right? The market movement is different and unique than economic performance. They can be related over longer periods of time. And that certainly is a relationship that is worth taking into account. But market prices can move very, very differently than what's actually happening in the economy.
Totally. And I think a good reminder, things are still happening. I mean, Elon's still buying Twitter.
Well,
after a long, back and forth, and I guess the pen hasn't, the ink hasn't dried.
I'll believe it when I see
it. We saw Trip Actions is raising $100 million. Like there are things happening is the point, right? Really good companies are still thriving. They're still growing. They're outperforming. There is a little bit of we hear it on the private side all the time. There's a little bit more caution, but which I think is a good thing. We're actually looking at profitability and cash and balance sheets, and some of that exuberance might be kind of drying up, but I think that's a good thing long term as well. So just, hopefully, at least what I'm taking away from this conversation is, it's tough. It's a tough period. It's tough to turn on the news every day and kind of see, well, shoot, is the market down 2%? Is it up 2%? Like, what the heck's going on? But scanning back out and really relying on, hey, if I've built my structure so that I've identified the things that are really important to me, those priorities, and then my portfolio is allocated to those priorities, I should have a lot of confidence in what's going on. And the things we focus on is just the zingers. So I'll give you just one zinger for anybody listening to use this week. And it's that stat I went through, the dollar invested in the S&P 500, the end of 1991. Ask your friends, ask your teammates, ask the people around you, hey, what do you think that dollar is worth? At the beginning of this year, what do you think it was worth? And the answer is $20.82. Pretty remarkable. And then the punchline, hey, what if you were a trader? You thought you could predict the future and you missed a few. You missed only 50 days. You just missed the 50 best days. What do you think you got? And the answer is $1.62. Yeah. To me, I know I'm more analytical, but that's pretty darn convincing.
It is. And I think I would just add to that, you had to go through periods. We're looking back at actual data. You had to go through periods like we're seeing this year.
Absolutely.
The last couple of weeks specifically to actually get that. Unfortunately, that's the pain that you kind of have to experience to get the reward.
Yeah, definitely. Well, as most people listening know, you've heard me say it before, but shoot us a text and we'll get you. One thing we'll do is you're probably listening to this in the car or on a run. We'll actually shoot you a text with those exact stats so you can accurately quote it. But to get on that, just shoot me a text at 602-704-5574. We'll shoot that over to you. Would love to hear any topics that are top of mind for anyone, and we can tackle them in future episodes. But until next time, own your wealth, make an impact, and always be a pro.
The information in this podcast is educational and general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision.